Hi, Bryan Hancock here for the next episode of the Timberchase Financial Wealth Brief. Today we're going to talk about whether or not you need a long-term care insurance policy. Whether you need a long-term care insurance policy is several questions under the same umbrella. Do you need a long-term care insurance policy at all? Should you keep the policy you already have? And if someone approaches you about coverage now, what type of policy deserves consideration? If the policy is a paid-up policy, what exactly are you being asked to buy? A useful place to begin is the basics, the definition of insurance. The purpose of insurance is to transfer a risk that one cannot afford to bear. Long-term care is a genuine risk. It is believed that more than half of our aging population will need long-term care services at some point, and about a quarter of us will need care for more than 5 years. It is good to plan for this very expensive possibility, and buying insurance is one of several options available to you. Whether someone needs a long-term care insurance policy depends less on fear and more on financial reality. If an extended care event would materially impair someone's financial situation, then transferring at least part of that risk may be sensible. If the family can retain the risk with confidence, then insurance may be optional rather than essential. The decision depends on age, health, retirement goals, income, assets, and even your tax plan. There is a saying about long-term care insurance that if you can afford it, you don't need it, and if you need it, you can't afford it. There is some truth here. If you can afford it, it is worth understanding how a long-term care event would play out financially and if insurance is likely to help. For families who already have long-term care insurance, the answer is usually proceed carefully before canceling. The market has changed materially over time. Older standalone policies were sometimes priced too optimistically, and later claims experience proved that they were underpriced. Over time, that contributed to premium increases and a broad market toward hybrid or combination products. An older policy may be more valuable than it appears. A premium increase is unpleasant, but that does not automatically make cancellation wise. In some cases, the older contract may still compare favorably with what is available now. New coverage may be more expensive, less generous, harder to qualify for, or some combination of all three. So the question is whether keeping the policy is still the best use of premium dollars inside the broader financial plan. Broadly speaking, there are three categories of long-term care insurance policies. The first is traditional standalone long-term care insurance. This is the older, more familiar design. It is built specifically to cover qualifying long-term care expenses, whether in a nursing facility, assisted living setting, or home care environment, depending on the contract. The second category is a life insurance policy with a long-term care rider or similar chronic illness feature. These policies are often attractive to people who dislike the idea of paying premiums for something they may never use, because if qualifying care is needed, the death benefit may be accelerated to help cover those expenses. If care is never needed, the policy may still pass a death benefit to heirs subject to contract terms. The third category is a broader hybrid or combination market, often tied to life insurance or annuities. Insurance is all about probabilities. Our opinion is that the more complex the policy, the less probability of a consumer getting value from having it. A paid-up long-term care policy means a large premium is paid at the beginning rather than spread over many years. Some people prefer certainty and want to pay once without having future premiums. These can be more attractive to those with an estate tax problem, as paying the premium can reduce the taxable estate. However, more wealth can be a reason not to buy a paid-up policy since a family has resources to self-insure the risk. If you are advised to buy one, get a second opinion from someone who does not have a commission incentive to sell you one. Ownership of long-term care insurance policies remains relatively low, about 15% of those aged 65 and older. That tells us most families do not solve this issue with private insurance. Some consciously retain the risk, some cannot justify the premiums, some never analyze the issue carefully. Others may eventually rely on family support or public programs. One concept can get missed in deciding the best path, and that is families sometimes look at the cost of assisted living or nursing care and assume that figure simply lands on top of the existing household budget. In reality, an extended care event often changes the rest of spending. Housing, maintenance, utilities, groceries, transportation, travel, and other recurring lifestyle expenses may decline or disappear. That does not make care inexpensive. It does mean the net burden may be different from the headline number. The cost of care can be less than the cost of reduced expenses for some people. There may be also a significant tax implication here. Qualified long-term care services may be included as medical expenses when they are required by a chronically ill individual and provided under a plan of care prescribed by a licensed healthcare practitioner. Publication 502 also explains that in certain institutional settings, meals and lodging may count as medical expenses when the principal reason for being there is medical care. For affluent families, this can create room to recognize more income because the deductible medical expense can lower the marginal tax rate, which may also allow larger individual retirement account distributions or Roth conversions during high care years. This can have the net effect of reducing tax for beneficiaries in the next generation. Long-term care insurance is not always a purely mathematical decision. There is also a human dimension that deserves respect. Although this is difficult to prove empirically, families with coverage seem more willing to accept help sooner because the care feels as though it is being paid with other people's money rather than from their own pocket. Without a policy, the opposite can happen. A couple may delay bringing in help because every hour of care feels like an out-of-pocket loss, and asking for help may feel like defeat even when the need is clear. A familiar example is the exhausted spouse who becomes the default caregiver while insisting on managing alone. Over time, that arrangement can wear down both spouses. In some cases, the practical value of a long-term care insurance is not that it produces the highest mathematical return, but that it gives a family permission to act earlier. Self-insuring long-term care risk may be the more rational path when there is enough money to absorb the cost without disrupting the rest of the plan. A large percentage of policyholders will either never use the full benefit, use only a modest portion of it, or surrender value through years of premiums for a risk that never materializes. For a family of means, retaining the risk can be a good decision. In that case, long-term care insurance may solve more of an emotional concern than a financial one. Should I cancel the one I have? Sometimes the answer is not buy one or cancel one, but analyze the one already owned much more carefully. And sometimes the real issue is not whether to insure the risk, but which version of the risk should be retained, which should be transferred, and whether the policy being proposed is solving the right problem in the first place. If you would like help deciding if long-term care insurance fits into your plan, give us a call. We don't sell insurance, and we have no incentive for you to buy. Our focus is on helping families make the best decision for them. Call if we can help, or email me at bryan@timberchase.net. Thanks for listening.